Today we're going to talk about how corporate class mutual funds work. In the beginning, the investors who wanted to acquire professional investment management used mutual funds that were primarily in a trust format. As a result of this trust format, they received a T5 at the end of the year containing their pro rata share of all of the investment income earned inside that pool without any planning on their part. They may well have in fact received dividends, capital gains, interest and foreign income, again with very little notice or planning on their part. This would often happen even if their fund lost fair market value over the year, which confused most investors, as you can imagine. And finally, if they wanted to reallocate their investment from one fund to another, that created a disposition for tax purposes and triggered any unrealized capital gains or losses, again with no planning on their part. In the late 80s, corporate class mutual funds were created to offset some of these problems. They simply held multiple pools or funds of investment dollars inside a single purpose corporation called a corporate class mutual fund. This allowed for greater tax efficiency and allowed the investor to change from one fund to another on a tax-deferred basis as long as those funds were all in the same corporate class. However, by law, a corporate class mutual fund can only distribute dividends, capital gains, or return of capital to its investors. It may not distribute interest or foreign income. So to offset these, and because all tax decisions are made at the corporate level, not at the fund level, common expenses such as management fees and audit expenses are used to offset those on the corporate tax return for this corporate class mutual fund structure. There are times, however, when these excess high rate incomes exceeded the common expenses. It was common practice for those to use a forward contract to recharacterize this interest or foreign income as a capital gain. This capital gain could by law be distributed. However, these forward contracts were eliminated effective December 2014 in the most recent federal budget of March 2013. As a last resort, these corporate class mutual funds could pay tax on this excess high rate income, but this is rarely done as this creates an unfair double tax eventually to the investor. So that brings us to NexGen Financial, which is in fact the next generation of corporate class investing. It is easy to say that traditional corporate class in essence recharacterized investment income to make it more tax efficient to its investors. What NexGen is able to do is to reallocate or stream investment income to the investor who has a preference for it. The trick with NexGen is we're able to bring the RSP investor into the structure to the benefit of all. You understand that regardless of what investment income or return is made by the investor in the fund, that's exactly what they end up receiving. All we are doing is making up that return in a different fashion based on the preference of the investor. So the RSP investor receives that return as high rate interest income, while the non-registered investor will receive the low rate preference such as dividends or capital gains. So this makes every investment decision at NexGen two, not one choices. First, you select the mutual fund that fits your risk tolerance and timelines. Second, you pick the tax class that fits your tax objective. These classes are, and our objective is to provide you with compound growth. That is a deferral of all growth in your fund. No T5s are expected to be distributed, and we expect to provide you with an unrealized capital gain that's triggered at redemption. Second would be capital gains distribution. Our intent here is to provide up to your annual return as a capital gain on a T5 provided to you at year end. Third is return of capital. monthly flow of your own capital coming back to you to spend, and deferring all of the investment income once again as an unrealized capital gain. Dividend Tax Credit Class is a monthly flow of eligible Canadian dividends, providing you with an efficient investment income regardless of the fund you selected in the first choice. Lastly, it's our registered funds, which provides RSP and TFSA investors with an investment return, and when they are ambivalent to the investment income that makes up that return. Hopefully this helped you understand how corporate class works and will be working in the future. And we'll see you next time on Tax Alpha.